Interest rates may finally be going down after the Fed announced potential rate cuts throughout 2024. With the economy looking good and inflation cooling, the times of sky-high interest rates could be coming to an end. In this video, let's talk about why interest rates might be cut, and more importantly, what does it mean for you? Let's get started. Recall that the reason we're in a high interest rate environment right now is because inflation was getting out of control. We saw 6%, 7%, 8% inflation rates throughout 2022 and the beginning of 2023. Everything was exploding in price, from gas to food to housing. A little inflation is fine, but a lot of it, not so much. Rapid inflation is an economic threat because it deteriorates the purchasing power of our dollars. What I can buy with $1 today isn't nearly what I could buy 5 years ago. So seeing inflation way past their 2% target, the Fed took actions to fight it, most notably through raising interest rates. Not just by a large amount, but also very quickly. The idea is simple. Make money more expensive to borrow, and you effectively slow economic activity that bleeds into the supply and demand of goods and services. That's where we are today. The federal funds rate sits in a range between 5.25 and 5.5%. And if that's the cost for banks to borrow amongst each other, you can expect borrowing is more expensive for consumers like us. Mortgages are around 6-7%. Auto loans are anywhere from 6 to 9% for prime shoppers. And of course, the always dangerous credit card sits at an average 28%. But despite high interest rates for everything, the economy is in a real solid place, measured by metrics like the unemployment rate, which sits below 4%, and the latest jobs report showing employers added over 200,000 jobs in December, which beat estimates. GDP continues to grow, and consumers have maintained a positive outlook, resulting in strong spending. This is all while inflation has meaningfully fallen closer to the Fed's target. Yes, prices are still rising, but not nearly as fast as years prior. So if the Fed is successfully reducing inflation without tanking a solid economy, it then begs the question, why are they even considering cutting interest rates? To fight inflation, you raise interest rates, and you do that because it effectively reduces the impact of money circulating in the economy. But here's the inherent problem. Changing interest rates is a blunt tool the Fed uses. It's very easy to overdo it. The longer the Fed maintains an aggressive stance on interest rates, the more likely we are to enter a recession, where unemployment rises and financial markets enter corrections. So recession is exactly what the Fed is trying to avoid. They don't want to sabotage the economy as it stands today. This is what they're referring to as a soft landing, if you've heard that phrase thrown around. And that's the why to the Fed considering interest rate cuts. Rates come down, money is cheaper to borrow, capital investment in businesses goes up, and markets like housing are propped up by higher demand. And hopefully, inflation doesn't return. But what does all of this mean for you and me, from the point of view of our personal finances and investing? Well, it depends on one simple question. Are you going to be a borrower or a saver? If you're going to be a borrower, meaning you're interested in financing future purchases through debt like mortgages and auto loans, interest rate cuts are great news for you. Mortgage rates, student loan rates will come down. Auto loan rates will too. And all of the other debt products like personal lines of credit. This happens because in general, money is cheaper for banks to borrow amongst each other, and therefore, they can afford to lower what they charge on consumer banking products. The hope is that rates come down meaningfully enough to positively impact the affordability of these large purchases, because right now housing and vehicles are at historically low affordability. The one caveat is there's potential for lower rates to result in a huge surge of demand, causing prices for housing and vehicles and other products right back up. If prices go too high, they could cancel the positive effect lower rates have on affordability. Something to keep in mind. Also, if you're currently a borrower who pulled out a loan over the last year, rate cuts are great news because chances are your existing debt is issued at a much higher rate. When rates come down, you'll have the option to refinance and lock in better terms for that loan. Refinancing at a lesser rate will give you the ability to make the loan more flexible through lower payments or can expedite the time frame in which you pay off that loan. But do consider that there are often costs associated with refinancing and some pitfalls that result in you taking on more debt. So do your research and run the numbers to make sure it even makes financial sense. Now, if you're going to be a saver, interest rate cuts are a bit of a mixed bag. Depending on how you choose to save your money, will determine if cuts are good news or bad news. Most of us hold a significant portion of our cash savings in bank accounts. And hopefully, all of you are currently taking advantage of high yield savings accounts that pay significantly higher interest on your deposits than traditional checking and savings accounts. But here's the bad news. As the Fed cuts interest rates, high yield savings accounts will cut their rates as well. The accounts like Discover and SoFi will no longer pay interest on deposits as high as they are now. The days of 4.5% interest would be over. Now, that doesn't mean high yield savings accounts won't be worth it anymore. They'll still offer above market interest on your deposits, just not as much. So for that emergency fund, that down payment you set aside, it will still make sense to park it there. The same situation goes for bonds. If you plan on converting future savings into bonds, the yields you earn will also go down with interest rates. This is especially true for treasury bonds issued by the US government. Right now, you can buy treasuries, which are considered relatively risk-free, at yields higher than 4 and 5%, depending on their time to maturity. These bond yields beat out most high-yield savings accounts and are the reason treasuries have been such an attractive form of saving. So attractive, in fact, that even investors have had to reevaluate their portfolio's allocation of stocks versus bonds. Here's the silver lining for bondholders. If you currently own bonds that you purchased at these higher yields, the Fed cutting rates is going to make the bonds you hold more valuable. This has to do with the inverse relationship of bond yields and bond prices. When prices go up, yields earned go down, and vice versa. Okay, trying to keep this as simple as I can. When the Fed cuts rates, the bond you own that pays its holder a higher level of interest will go up in price. As the price goes up, the yield of that bond effectively goes down to match the new lower levels of interest in the markets. So your existing bonds will go up in value, and you can sell them for a profit without having to wait for the bond to fully mature. But whether you want to sell is completely up to you. Just know that rate cuts aren't 100% bad for bondholders. Interest rates might be getting cut this year. Why? Because the Fed doesn't want to risk sending the currently strong economy into a recession. And is this good or bad news for us? It depends on whether you want to be a borrower or a saver. For borrowers, good news. For savers, bad news with a little bit of a silver lining. And that does it for this video. Before you go, if you'd like to participate in the series where I react to your current financial situation, whether that be your assets and liabilities, financial hardship, or successes you'd like to share, you can submit an email at askalexherrera@gmail.com. All submissions will remain anonymous. As always, thanks for watching. Until next time, take care of yourself, and best of luck.